What's up, guys? It's Mike, the Everyday Money Guy. Welcome back to my channel. And today we're going to be talking about stocks and how we can take some of the mystery and misinformation out of these investments. Guys, when a lot of folks look at a stock, they see some sort of mysterious thing that's just on CNBC as a series of letters, and it has a price with it. It has all these, weird ratios that come with it, like price to earnings, earnings per share, their moving averages, things of that nature. And it makes it look like it's this very complex financial instrument, which in a lot of ways it is. But we're going to get way down and make it very simple to see exactly what a stock really is at its basic form. So in its basic form, a stock is just an ownership share of a company. And there can be thousands, millions, billions, even trillions of outstanding shares of stock. And each one of those is an ownership stake in the company that it is issued from. And so the takeaway from that is that in its basic form, a stock is not some sort of extravagant financial instrument that's super hard to understand. It is just a portion of ownership of a real company with real people making real products or services. Now, the price of these stocks is related to how much value that the company has. And the way that they go up and down is the people in the company create more value for the company and the shareholder. And when you look at a company such as like GM and Ford, they're competing against each other to have the best products on the market and to try to beat the other one. And that's where the competition comes from. As the products get better, the price of the stock typically goes up. Now, if you want to take it even deeper than that, every one of these companies is filled with people from the CEO down to the lowest level who are all striving, in theory, to make that company better, make that product or service that they offer better so as to drive more value for the company, which in turn would typically drive the share price up. So usually if a company is doing well, the price goes up. If the company is doing poorly, the price goes down. So at a basic level, you can look at that mysterious stock ticker with its price attached to it, and that seems so abstract, but behind those letters and numbers, there are actual people striving to make that a bigger, better company and to drive the share price up. For example, we'll just take a look at Amazon. Now, in 2020, the Goliath of internet commerce that is putting the traditional commercial models out of business. That is a business that started as a bookstore out of a garage, and it grew and grew, and he brought on people that could help make that bigger and better over time. And so the share price started to go up. And then what happened was, in that particular industry, they got so good at what they do that they started taking the traditional model and putting it out of business. So your traditional retailers like Sears, Kmart, JCPenney, Macy's, things like that, they could no longer compete with this business model that Amazon had set up. So their share prices started to decline to the point where some of those went into bankruptcy, where Amazon's share price continued to go up because they made such a good value for the customer that everyone flocked to that company, and therefore their stock price went up. Now, that's not to say that outside sources and other information can't affect a stock's performance. It's not necessarily related to its fundamentals. For example, anytime that there is unrest in the world, that can cause the price of oil to go up because of disruptions to the supply chain. If there is, for example, right now during coronavirus, every time there's talk of stimulus being put forth by the United States government, that isn't just the talking about that drives stock prices higher because people think that traders think that more money will be spent and that will drive stock prices higher. Also, you can have very good companies that end up having accidents or unintended consequences. For example, Boeing with their 737 MAX aircraft. Because of the accidents that they had with that, their stock took a giant hit, even though they have a backlog of airframe orders and a wide variety of products that sell very well. However, if the companies are in good shape and they're fundamentally sound, these things tend to even out over time. You get some highs and some lows based on some news. Maybe some institutional traders are trading very large amounts of shares for these particular companies, but as long as they're fundamentally sound, they'll even out over time. Now, some companies will come and go, and that's why I do recommend buying mutual funds instead of individual companies. And I will have another video on that about how it's not likely that you can be a great stock picker unless your name is Warren Buffett. Guys, I'm hoping that this explanation took a little bit of the mystery out of stocks and it makes them easier for you to understand that they are real people, real companies offering goods and services, and they are in competition with other companies to make them better. So they always have to be making the next best thing, be it cereal, your TV shows that you watch on your streaming networks, vehicles, everything that you purchase or consume, there is a company out there either trying to make it better or trying to make the same cheaper so that you'll buy more of it. And then that in turn affects whether the stock price goes up and down at a fundamental level. Guys, if you like this video, subscribe and stay tuned for my financial videos in the future. And hopefully we can make money easy for you. See you next time.